Welcome everybody to the set of the Building Equity Podcast for real estate investors. I'm James Schlimmer. Boy, do we have a show today. I mean, we are going to be sitting down with probably the most intelligent foreclosure expert in the country, Auction.com's Vice President of Market Economics, Darren Blomquist, today. You know, we are just getting into the foreclosure space as far as tracking it. I believe we're 24 months ahead of what's coming, and I wanted to be able to bring to you guys, the investors that are using your self-directed IRA to buy and sell real estate, I wanted to be able to bring to you guys just as much education as possible about this subject. And since we're relatively new, let's find the best out there, right? That's why we're sitting down with Darren today. So as always, please click subscribe to this show. Please continue to check back here, check back to IRATitlePro.com, because we're gonna have some amazing state-specific, local-specific foreclosure data you're gonna be able to get every single month in your inboxes. So listen, to start this show, we're not giving you any investment advice. We're not giving you any financial advice. This is our disclaimer. It's strictly for educational purposes, so please take that. As always, today's foreclosure report is brought to you by IRA Title Pro. If you are buying and selling real estate using your IRA, you should know about IRA Title Pro. Head over to IRATitlePro.com, take a click at the resources that are all designed to help you before, during, and after you buy, sell, or lend with real estate using your IRA. And again, we're doing the foreclosure stuff. We got some amazing stuff on single family rentals coming. So please click subscribe, head over to IRA Title Pro, and without further ado, let's get into this conversation with Darren. This is literally the first words I've ever spoke to him. I didn't want to rehearse. I wanted to be able to dive right in, and you could hear our conversation. So let's get to it.
Darren, thank you so much for joining the Building Equity Podcast. I know we just had a chance to talk a little bit before, but here we are. You're having the chance to share your foreclosure wisdom. You could be the foreclosure prophet, as I've been selling you to our listeners across the country, to many real estate investors that are using their self-directed IRA to buy and sell real estate. And one of the things I think it's important to get right out the gate is that currently you're the VP of Market Economics at Auction.com. Can you talk a little bit about what Auction.com is, what you guys are doing, and how you can help our investors?
Absolutely, yes. Auction.com is the nation's largest marketplace specifically for foreclosure auctions. We have a broad name, but we're specifically doing foreclosure auctions, which are the auctions that occur as part of the foreclosure process. Typically, in most states, are on the courthouse steps. In a few states, like Ohio is actually forward-looking. They're online, and we're bringing technology to bear in that, where we're allowing people to bid on those courthouse auctions from their phones as well with remote bid. A little bit of a tangent there. And then the other type of auction that we do is the bank-owned auction, which is very similar in some ways. It's after the property goes to foreclosure. If it doesn't sell to anybody at the foreclosure auction, it goes to the bank and it becomes bank-owned, also known as REO. And those are all online auctions. And in both cases, we're doing this across the country. And our mission really is to make the process, this historically has been a process that is available only to select investors who know the game and know what's going on and are kind of in that inner circle. And we want to broaden that circle and make this easier and more accessible for a broader pool of investors. And so, and people who are interested in investing in real estate, whether or not that's their full-time job. And so, you know, all I would say is just go to auction.com. It's not there's no cost to search and look and browse properties and see what's available on our site across the country.
It's a really, really straightforward platform. We've been looking at it for years. Let me ask you this. I heard a stat, whether it's true. Does auction.com touch 50% of all the foreclosures in the country?
Yes, I mean, we're self-proclaimed that, but I've actually used the Attom data solutions data, which is public record data, to look at that, and we in terms of foreclosure auctions, we're right at the 40 to 50% of those nationwide. And actually, during the pandemic, it went up a little bit because of the smaller pool of foreclosures. But yeah, we're the biggest player in that foreclosure space.
Yeah, you guys you're a monster, which is why as essentially the Building Equity Podcast and IRA Title Pro, and we bring this content to our investors, we're dipping our toe in the foreclosure space because I see that we're about 24 months ahead of something that's coming, and I think our investors should begin trying to get competent in this, begin looking to see what's happening in their local areas, and begin having these conversations. And you mentioned Attom Data Solutions. So let me just plug this. The data that you're going to see that we're going to present, it's coming from Attom Data Solutions. It is a complete coincidence that Darren previously worked at Attom Data Solutions. So when it comes to real estate data, there's many different sides of the coins where you can get information from, but the narrative is usually very, very close. So when I start throwing out some data points here, whether it's the National Association of Realtors or folks are using the Redfin data center, but couldn't be happier with Attom Data Solutions, Darren, by the way. So let me dive right in and just ask this question. For our listeners that haven't had a chance, you just released essentially a blog on November 9th, and it was called, I'm going to share my screen. You may be able to see it here in a second. Let me know when you do. It's called Sizing and Timing the Pandemic Backlog of Foreclosures, right?
Yeah, I'm seeing it. Mm-hmm.
Okay, cool. So I'm urging everybody to go read this because there is what I believe to be a glaring fact here that I just don't know if I'm misunderstanding the data. And what you talked about in here, right around this line, is Black Knight Mortgage Monitor says that as of July 2022, there are 420,000 unprotected delinquencies. And the first question I have is, can you define what is an unprotected delinquency for our folks?
Sure, and that is a term I coined. So I don't know if it's the best term, but in any case, it's delinquencies that have gone through the programs put in place during the pandemic to prevent foreclosures, which are foreclosure. There's of course foreclosure moratorium, which is a blanket moratorium. You didn't even have to do anything to qualify for that, but that ended at the end of 2021. Essentially. And so once, that was just a timing thing. Once we were past December 21, all delinquencies were no longer under the protection of the foreclosure moratorium. That's one protection. The other protection that was more proactive was the forbearance program. You did have to ask to be in forbearance, but there was a very low bar. You just had to say, I've been affected by the pandemic, essentially. And so those two were the two main protections. And so these are delinquencies, homeowners who are not paying their mortgage, and most of them are seriously delinquent, I would say, or even already in the foreclosure process. And they've gone through that forbearance program and they've exited the forbearance program, but they're still delinquent. They're not in any what the banks call loss mitigation programs that would try to get them on a new payment plan to try to get them performing on their loan. So that's what unprotected. Really, these are the high risk delinquencies. There's nothing stopping them from moving forward in the foreclosure process.
Okay. One of the things, and I'm sure you see this online too, because you have an online presence as an expert in this field, I feel like there's so much clickbait about the collapse of the real estate industry and these headlines just to get folks to click. And I would say up until I was preparing to have this conversation with you, I would say that no, the market is going to correct. And that's where we're in. It went crazy. We were getting ready to correct. But unless I'm seriously misunderstanding this data, I may change my mind on that. So here's my question for you. 420,000 delinquencies as of July 2022. Okay. Is there a stat anywhere that says how long is somebody usually in a property before they become delinquent? Let's say like a 30-day delinquency. Is there a kind of a industry number to go by? I couldn't find one, but I'm asking you.
I don't know. So you're asking like, what's the typical time before somebody becomes delinquent? I don't know that there's one out there, and I think it really varies because it typically, it typically has to do with some unexpected either life event.
Yep.
In kind of a normal market, foreclosures are driven by individual life events. Unfortunately, bad ones. Loss
Yep.
of job is the main one. Divorce, things like that, death, unfortunately. So not great things fun things to talk about. How the wave of the increases in foreclosures when we see the tide rise or the tsunami like we saw in 2008, that then has to do with some kind of external shock to the economy. So anyway, all that to say, I don't know of anything. It can vary quite a bit. There's no set time that I know of that it takes for folks to go into foreclosure. One of the things we keep our eye on, though, that's related to that, I think, is early payment defaults, and the FHA tracks this. It's within 6 months, if there's a high percentage of folks who, after they originate a loan, get a new loan, are defaulting within 6 months, that's a bad sign. That's kind of an early warning indicator that something's going on underlying that's more than just individual life events. So, and that became elevated during the pandemic. It's still, that early payment default rate is still elevated, although it's come down quite a bit since the spike during the pandemic, but it's still higher than it was before the pandemic. So that's a little bit of a low-grade fever warning signal that we still have in the works right now. So all that to say, you're probably trying to get at another point here by asking that question. Yeah.
Everywhere you're going, I appreciate, because you're giving the fundamentals, and I'll take the fundamentals. I know our listeners will take the fundamentals, so please go, and I will get you to my point ultimately here. One of the things I learned about you, and correct me if I'm wrong, but when you kind of started your career tracking the foreclosure space, I don't know the company that you were with, so you can quote me on that, but you guys were like, holy heck, this is just before the Great Recession. You're like, holy heck, there is an unbelievable amount of foreclosure starts, to where the industry and the banking industry was looking at you saying, no, you guys, you're misinterpreting the numbers. You're doubling the numbers. This isn't true. And you're like, no, we're right. And it turns out you were. And then boom, within 24 months it hit. Is that about right?
Yes. I mean, I love that you found that story, because I'd love to tell it. So I guess it's probably all over the place. But it was Realty Track, which actually became Attom Data Solutions. It was the same company, but it kind of evolved. So yeah, back in, really it was around 2005, Realty Track, and we said, hey, we have all this foreclosure data. We were collecting it for individual investors to be able to access it online, and we have all this data. Let's put out a report. We don't see any report on foreclosures. And it wasn't long after we started putting out a report that we started seeing these huge increases. And to be fair, we probably stumbled into it a little bit and didn't even realize how big of an issue it was. But we started reporting these big increases in foreclosures, and we did get pushback from folks in the industry who said that it wasn't a big deal. This was going to be they were using words like soft landing. Even at that point, it was, there was acknowledgement that the market was probably overheated and had some, needed to let some air out, phrases like that. But we did get, accusations that our numbers were sensationalized and clickbait, maybe that word wasn't in use back then, but
I think it's important for our listeners to know that you were sitting in the seat then, and there was the industry, and I say the industry, usually National Association of Realtors always is trying to put a positive spin on what's going on, and they should. Obviously, they promote the buying and selling of homes. The Mortgage Bankers Association, they want people to get loans. We get it, but folks got to be able to look through kind of that, understand the spin that they're doing. And this kind of leads me to my greater point. I'm going to share my screen again here, because that 420,000, and for me, what you're seeing here is our IRA Title Pro data center. All this is we're just bringing in data on existing sales, Darren, here. This is from the National Association of Realtors, right? The latest update was September. We're waiting for October's numbers here. You may use, there's obviously Attom, there's Alto that may have a little bit more timely, which you usually get ahead of the game. Who knows? I'm making an argument here, so follow my math, that somebody could be comfortably in the house for 6 months and then they're going to go delinquent. I'm picking 6 months as a period. But 6 months also coincides with January of 2022, which is literally the peak of sales. And you're talking about 6.49 year over year sales, right? And you obviously see that. I'm going to come back here so I can see it here. So you got 6.49 sales in January. You're saying that in July, 420,000 delinquencies. If I take the 6.4 million sales and the industry standard, you could say, and anybody can go look this up, is that 80% of transactions are going to be financed. Buyers are acquiring those properties with a loan. And, give me a thumbs up if you're with me, right? It's kind of
so far I'm with you. Maybe it's 20, maybe it's 75%, but yeah.
Yeah, 100%. I think it's actually 76, but let's just say 80 for simple math.
Sure.
Which is wildly different. I'm in Naples, Florida, where I live, and we see 60 to 70% cash. But regardless,
Yeah.
throughout the country, 80%. So, okay, 6.49 million, 80% were loan. That's 5.1 million loans. And if we go by and say it takes 6 months, nobody knows this number. How long does it take for somebody to become delinquent? I'm saying 6 months. 420,000 into 5.1 would assume an 8% delinquency rate. Tell me I'm wrong.
You are wrong. I think because, the one thing that just a little bit off there is that the 6.49 million, that's an annualized number.
Correct.
So that wasn't how many people bought in January. It's how many, at the rate there were buying in January, how many would have bought during the year. So actually, maybe it actually makes your delinquency rate much higher, obviously. But if you're just, the other piece that I would just say is incorrect is that, those 420,000, which, by the way, I wanted to mention, that's since I put up that article, I wrote that article, it's risen to 488,000 according to the back night data. So that number is actually going up.
It's not disproving my theory here, but go ahead.
Yeah. I'm not necessarily disproving your theory, but just walking through those numbers is that 488,000 now unprotected delinquencies are not necessarily all new delinquencies from and tied to the January numbers. In fact, I would say the majority of those delinquencies are from properties that were purchased many years ago. So maybe I'm not completely following your argument, but there's not that direct. You can't just take the sales in January as the denominator and the 488,000 as the numerator in the equation.
And I'm definitely picking up what you're saying there. Now, to let our listeners know, the Mortgage Bankers Association, they put out an article. I want to say it was, I will hold me to it here. It's going to be right down here, that the delinquency rate as of Q3 2022 is at the lowest level in 43 years, 3.45%. I can tell you that the peak delinquency rate during the subprime crisis, at least reported, is 9.3%. So somewhere in this 3.45 and 9.3 is where this delinquency rate lives, okay, on average.
Yep.
It's just interesting that what the Black Knight numbers that are being reported, clearly, you have folks that have been living in properties that could be 2, 3, 4, 5 years, and then they're becoming delinquent. I definitely think that that's a number worth monitoring. Clearly, so do you, because you're reporting on it.
And I would just to point out the Black Knight overall, and I think I showed it even on that chart in that you showed earlier, is if you look at the top line delinquency numbers from Black Knight, similar to MBA, those are going down. Those numbers are close to or at almost record lows, just like the MBA numbers,
Yep.
overall delinquencies. So
Okay.
I'm trying to quantify and really focus in on the backlog that basically foreclosures that would have happened during the pandemic if there were none of these extra foreclosure protections put in place.
Sure.
And to me, that's those unprotected delinquencies. So those numbers are going up, which is an indication to me that those are the backlog, and they're going to be coming through the system fairly soon. They're delinquent. The next step is foreclosure start, and we are seeing increases in foreclosure starts. So just to clarify, both Black Knight and MBA are saying overall things are going down, but there's this subset of delinquency that's rising, even while the overall delinquencies are going down.
Okay. And I'm gonna come back to that rising factor in just a little bit, because there's two other variables that are just happening throughout that are being reported on. Household debt, credit cards, and auto financing delinquencies. But I want to come back to those in just a second here, because in your article, obviously you talk about the 420,000, and what you mentioned is that you're expecting to see 96,000 foreclosures, essentially complete the entire process from July the 1st, 2022 to June 30th, 23. With me so far on that number that you mentioned, right? Okay. So let me share my screen here, and you're going to see this is our nationwide dashboard for foreclosures. And the data is coming from Attom here. What you're looking at on the screen here in the upper left is just our starts. Notice the default list pendants throughout the country. This is as of October's numbers, just so you know. It's not year to date, it's just October's numbers. Then we have our notice for sale, and then the bank-owned property where the bank took over the property. And then obviously we can drill into throughout the country and so forth, which I'll hit you with. But do I have this correct in saying that if you believe that we're going to see 96,000 complete the process over that 12-month period, based on October completes, which was about 4,100 here, 4,156, we should expect to see about a 95% increase here. We should start seeing this number month over month be about 8,000 in order to hit your 96K. Does that sound about right?
The only thing is the bank owned is kind of half of the picture. So when a property when it completes foreclosure, at least by the way I talk about it, is that it means it goes to that foreclosure auction, but one of two things can happen at the foreclosure auction.
Yep.
It can become bank owned, or it can sell. And right now we're seeing about 50% sale rate. So the bank owned would be about 50% of the 96,000.
Good to know.
Total.
So that's an awesome point. This is why we have an expert here. So literally this should hold constant, this 4,150, about 4,000, because the other 4,000 are selling on the courthouse steps. That makes your 8.
Yep.
Okay.
Yeah. So actually in with that number there, which that's a little bit, I would expect that number to be going up. I mean, the 96,000, when we look at the numbers, would be a pretty substantial increase off of the previous 12-month period.
Yep.
So, yeah.
Yeah. And when you talk about the moratorium, you say that ended in 2021, right? Was that December 31st, 2021?
Yes, without getting, I can get into the details. There was a little bit of a gradual expiration of that, but yes, ultimately I would say it ended in December 2021.
Okay, am I wrong in saying that from the standpoint of it's like the percent increases from last year to this year, even this year to next year, the percent increase, that headline, 400%, 300%, all that, it's because there's such a backlog, it's going to look enormous, the percent increase, right?
Yes. Yeah.
Okay.
Because 2021 numbers were suppressed by the moratorium. Yeah.
Okay.
Artificially low.
So let me ask you this question here. I'm very excited about this. The nerd in me is very happy here.
I'm loving these dashboards. These are great.
Cool, man. I appreciate that. I'll show you too what we're going to, the state specific one that we're going to have for our investors in just about a week. We'll launch it. But anyways, when you look at the starts, and we kind of agree that there's about 14,000 and change per month. Is that kind of, regardless if you're using Attom or any other platform, is that standard?
Yeah, that's it's actually a little bit higher than that because in some states, some states don't have a separate notice of default. The first notice is the notice of trustee sale, which you have in the 13,000 number.
Okay.
So actually, some of that 13,000 would be a start to not. Sorry to cloud the issue a little bit,
That's
but
okay.
I'm seeing and using the Attom data, when I kind of combine those and come up with starts, and actually Attom does it themselves. It actually ends up being about 24. Well, I'm looking at the August numbers. These are October, but it's been around 20 to 25,000 the last few months. So you almost combine those two numbers there to get at least the way I think about foreclosure starts. Yeah.
Oh, so really you take the two, because how many, do you know how many states are actually just start with the notice of sale?
It's and Attom could tell you this as well.
Okay.
It's not too many, but I mean there's a couple big ones such as Texas and I believe maybe Georgia and Arizona. So there's a few big ones. So it ends up not quite being adding those two numbers together, but close in that ballpark of adding those two numbers together as starts.
Got it. Based on that, that's very, very good to know. I will dig deeper into that. This right here, we're looking at August numbers. In my rationale, and I am a real estate investor, to me, knowing the starts separated from the notice or sales is, especially being able to drill into a county or a zip code. If I know the starts, okay, I know where to start looking for properties in the zip code to be able to essentially make offers to these folks. And then when I notice that there's a increase in the notice of sales, I know how to start getting my money in order and checking the county website for what's going to be coming up for title searches and so forth, essentially just getting prepared. And then when I know that there's the bank owned, I can start looking at, clearly, let's reach out to these banks because banks don't want to hold these properties, or get over to auction.com and make a move, is essentially why I have it laid out the way that it is.
Yeah, I love that. And yeah, from a real estate investor perspective, that's great because, I mean, from auction.com perspective, or at least, we're not set up to do anything with starts other than know that there's probably some volume coming our way down the road.
Yep.
But from an investor perspective, that's important because those are potentially actionable purchases for you at this point.
Sure.
And in fact, you could argue this isn't in the best interest of auction.com necessarily, but you could argue investors might basically beat out the competition at the auction by going to those. It's harder. I mean, it's a harder process to go to those homeowners, but it's certainly a good strategy.
Yeah, I mean, it all just depends on the circumstances of the deal, but cash for keys, deed in lieu. I mean, this is what they exist. But okay, so let me ask you this question here. If the 96K number, which it does make sense now that you really talk about, you're almost combining the two, the notice of sale in there, but if 25% of starts complete the entire process, is that stat about right?
Starts to, historically, I should know this off the top of my head. I think it's a little bit higher than that, but we can use that as it's more like 25% of delinquencies roll to completed foreclosure, and then starts, it may be close to 40, I think 40 to 50%.
Okay, that's a wild difference here. So yeah, the 25% of delinquencies, you're 100% correct there now that you say it, will make their way all the way. But you're saying it could be 40 to 50% of official starts, paperwork filed, make their way through, which increases this number even further because I was expecting here, actually, no, this should still work. If you're expecting 96K,
And I should say the 96K is just coming from that backlog.
yep,
And then you, on top of that, you would add some on top of that for just kind of business as usual foreclosures, I guess, for lack of a better way of saying it. So the 96K is coming specifically from the delinquencies that are backlogged from the pandemic, but there could be more on top of that that come through as well, in addition to the 96K.
are you thinking, or should we expect to see that these starts grow on a month-over-month base and hit in the 30,000 range? I'm saying 32, or because these numbers are combined in your case, they're already there.
Yeah, I mean, when I'm looking at a chart I have of the Attom data, and it is, well, it's still around 25K right now. And so, but it has been increasing. I mean, there was a huge increase right at the beginning of the year because
Yep.
coinciding with the moratorium. We've seen it kind of plateau, but I wouldn't be surprised. I think about this in two ways. There's this initial kind of spike that we saw this year in starts has to do with the backlog from the pandemic. But then there's a whole nother potential, I guess, cohort of foreclosures that could be coming out of the economic issues that we're having right now. So that's a whole nother discussion too, in a way. But I think right now we're talking about the starts that we're seeing now, these 25 to 30,000 are coming out of that backlog of the pandemic. And they're actually, if you just took this, there's going to be this big increase, but to your point, it's coming off a very low level, and we'd really be returning to about pre-pandemic levels, if not a little bit even below pre-pandemic levels, with just this trend. It's the second trend behind that could provide an even bigger inventory of foreclosures that would come through, probably more like 2024 rather than 2023.
Hence the reason why I think we're 24 months ahead. So it's interesting. So one of the things that I haven't even really thought about is you're right now reporting you're heavy focused on the backlog, which makes perfect sense. Whereas I am looking at the current economic conditions and what's unfolding with unemployment and so forth and making a narrative. But really, the two together don't paint a wonderful picture about the foreclosure market. That being said, because we never say it's good that there's foreclosures because it's bad for people, but for real estate investors, they do need to know about it, obviously.
Yeah. And I would just that's kind of a passion of ours is, of course, yeah, we're accused of being the vulture here. I mean,
Yep.
even though we're not the ones foreclosing, but we think the more that we open up this process to a broader pool of investors, the better it ends up being for even these homeowners, and even the neighborhoods that they're in, these properties. When you have a broader pool of investors, a better chance that the properties will be taken care of and actually be renovated and returned to the market as functioning, livable properties. So just a little bit of a
It makes sense.
a rant there. Yeah.
So I heard a number that during the peak of the foreclosure crisis, they were seeing about 180,000 foreclosure starts. Is that in the ballpark?
I believe so. Again, that's a number I should know off the top of my head. I don't have it right in front of me, but yeah, I mean, the numbers that we're seeing now are dwarfed in comparison to the last crisis for sure.
Okay, and I just think it's important to bring that up. Now, one of the things that I'm looking at here too, and this is not taking into account the backlog. This is literally what's happening here over what's in the current economic conditions. So go with my math here. If I look at the September NAR numbers, we're down to about 4.7 million sales year over year. And, obviously we use the 80% number. That is 3.7 million loans issued. Okay. And if we use the 4% number of a delinquency rate, that would be about 150,000 loans are expected just on average to go into delinquency. Right? So with me so far?
Yep. Yeah, that makes sense.
Okay. And on the high end, if let's say you were to buy into this total collapse and the world is going to end, the high end would be 330,000. That's 9% delinquency, which is what we saw in the Great Recession. And and the only reason why I bring that up, that 9% number, is because I'm starting to really believe there's something to that Black Knight data, that 420,000 and so forth. But it's too soon to say. Split the difference. 150,000 on the low end, which is standard. If you go 6.5% delinquency, you're seeing 240,000 delinquencies. Now, of those 240,000 delinquencies, if I split that difference, we can say that 25% would complete the foreclosure process, right? That's just kind of the industry average.
Mm-hmm.
That's 60,000. Right? Which would be, I guess, I don't know the narrative that I'm not trying to paint a narrative here, but I'm showing that there would be another 60,000 pumped into the system over the course of your 96,000 backlog is what I want to paint here.
Okay.
And that could still be, you're well below the Great Recession, no problem. But we're not even taking into account the fact that these people that bought are upside down.
Right. That's a great point.
And because the property values are going to be going down, right? Because stuff isn't going to sell, interest rates are high. So at just a normal situation, that's your delinquency rate. That's what you're going to see is 60,000 foreclosures. But and here's ultimately my question for you, because you kind of did see this, when people are upside down, and arguably, I don't even think it's an argument, everybody that's purchased over the last 12 months with a loan is going to be upside down. Even though NAR may say you're going to see a 1% price appreciation, I just don't see how it's possible. Anyways, what does that mean when people are upside down? Clearly, they'd be more inclined to walk away, is what I would say.
Absolutely. Yeah, I mean, there's, as I mentioned earlier, what the cause of foreclosure is traditionally some kind of shock to your income or life. But then usually on top of that, the thing that makes a foreclosure much more likely is if you don't have equity in that property, there's not as much reason to try to save the home and stay in the home. Motivation. So we see that, when we run regression models on this, equity is a huge piece of the equation. And I don't know if you want, I could share my screen or I could just talk through some of the numbers, because we've run the models and said, okay, what's the volume look like if there is a home price downturn, if there is a recession? And it definitely has an impact on the numbers. It goes from, let's say, around that 196,000 we talked about, although that number is a little bit higher now because of the higher 488,000 instead of 420,000. But if we saw a combination of a recession and home price downturn, we're figuring more like a volume of 278,000 as opposed to around 100,000. So and that may not all be in 2023.
I hear you.
But the point being is the volume does accelerate quite a bit when you add in the factors of a home price downturn, which takes away equity, especially for recent buyers, and recession, which adds to the unemployment and people who are losing their jobs, unfortunately losing their income. So it can go up pretty dramatically. I would say the one wild card here is, especially on the heels of the pandemic, is government intervention.
Sure.
If we see some of that stuff happen, will the government once again step in and declare emergency and stop foreclosures? Yeah, I mean, it's definitely within the realm of reason, I think, although, my pushback on that is that we're, even at 278,000 foreclosures, we're at that number back in 2009 was a million, close to a million.
Yep.
So we're way below that level. It's still not that tsunami that we saw during the last recession.
I 100% agree. And again, we're just, the disclaimer here is nobody wants unemployment to go up. Nobody wants foreclosures to happen, the American dream. But the reality is, for real estate investors, it's not the narrative of this complete economic real estate collapse. But there are going to be significant opportunities for real estate investors to pick up foreclosed properties, or to be able to make offers to folks that are currently delinquent. There are these deals, and those opportunities are going to grow exponentially, is what I would say, over the next 24 months, which is why we're talking about it.
Yep, I think that's a great point. The other side of the coin is just thinking about, you are buying in potentially a market that's coming down. So you get the discounts on the front end, the more opportunities and discounts on the front end. On the back end, you do just have to be thinking about your exit strategies and making sure that you're thinking about that. If you're rehabbing and reselling into the market, a market that's coming down, you just have to be careful there. And yeah, so go ahead.
I know, I love your point. And I'm always of the mindset as an investor, this is not investment advice, but you always try to find who's way smarter than you and see what they're doing. And yesterday, when JP Morgan announces $1 billion to purchase roughly 9,000 homes in total with that $1 billion, but they're going to start in the Sun Belt. Why are they buying those homes? They're not buying them to fix them and flip them. They're buying them to put renters in, because the ability to buy a home is out of touch. You need to make 6 figures plus to be able to purchase a home, right? It's ridiculous. So just something to think about. A lot of our investors anyway, Darren, are buying a property, they're putting a tenant in, they're having it as a long-term investment, usually about 5 years or so. So anyways, let me ask you this. Logically, you would think that unemployment rate and foreclosure starts would be directly related. But is there a greater story in those numbers where our investors can look and say, okay, we see unemployment rate today is 3.7%. It's projected next year 4.6 to 5.5 on the high end. Is there a timetable that you guys look at to say, okay, hey, when we see, unemployment's announced at 4, it takes 15 months, for foreclosure starts to be affected. Is there that parallel at all that we can try to draw something from?
Yeah, I mean, just at a very high level, when we look back at, there's a very high correlation between unemployment rate, just mathematically, and foreclosure start, as well as even foreclosure. Well, first of all, delinquency, and then foreclosure start and foreclosure completion. Unemployment has a very high correlation to all of those. Unemployment rate specifically, and yeah, the time frame from unemployment rate spiking to foreclosure starts spiking is about a year. At least it has been historically. So it can take some time. But yeah, there's definitely that correlation.
Okay. We brought this up earlier here. Share my screen. This is, I mean, it's everywhere. Folks are reporting on this, but okay. Common sense to me again shows you've got folks, or let me ask you this. I believe you got to have this down to a science, but the first thing that folks start doing, I would imagine, is charging their credit cards. The next thing that they start doing is, I'm going to give up making a car payment. And then you start getting into, I'm not going to pay my either rent or my mortgage. Is that process correct?
I think so. I mean, we see some behavior by, and even during the last recession, that was not always rational by buyers. But so you're saying they stopped making their credit card payment first, right?
I don't
Yeah.
want to get, you can't hold to what's going to happen here, but
Yeah.
if you look at the story that's presently happening today is there's 3.5% of customers are behind on their auto payments today. And credit card debt is at the highest level it's been in 43 years. Fact.
Yeah. And that number went up. Yeah. So I think that's to your point, rather than trying to quibble or get into all the nuances, I think your point is very well taken, that those are kind of another one of those early warning indicators,
Okay.
like the early payment defaults, of potential stress on the finances of American consumers. And that would translate potentially. You would think that most consumers, rational consumers, the mortgage would be one of the most important payments, and they would stop paying other things before they stop making the mortgage payment. But yeah, so I think I definitely have my eyes on those numbers, those credit card, the credit card debt, but then also the credit card delinquency. And I think that's numbers that are coming from the Federal Reserve, at least the ones I was looking at. So yeah, I definitely took note of those and saw I'm seeing those as a potential early warning indicator of this next potential cohort. I'm trying to avoid the word wave.
Yeah.
For some reason, I don't know. But this next potential cohort of foreclosures, of distress coming through the system.
Is there anything that you guys look at or doesn't even exist, like utility bill delinquencies? Whether, I would imagine electricity and water would be the last thing to go, but what, cable, that to me would be, we're not paying the cable bill, type thing. Does anybody look at that? Have you ever looked into that?
I think there is some data out there on that. That's not data I regularly look at, but I think it would be a really good one to look at as another early warning, or actually maybe a late warning indicator. I mean, these people are really getting up against it when they stop making some of those payments.
That's how nerdy I am. So
I love it. Yeah.
All right. So listen, I've got you for 4 minutes left. And one of the things I wanted to ask you too is if we were to start getting into some geographical areas, I pulled this article. This is from Forbes. This is from, I think, April of 2021. So I would say we're in the heat of this frenzy of buying and the top hottest housing markets, right? Because I want to draw a conclusion and say, okay, wait a second here. The hottest markets where folks purchased, and in this article, they talk about folks that bought above list are going to get hit with the largest price decreases. And the folks that did use leverage to get these properties, would there be opportunities there from a foreclosure standpoint? So my question for you is, are you looking geographically throughout the country? Like Boise, Idaho is typically what hit the number one top of the list as far as went bananas. Mm-hmm. Is there an area of the country that you're looking at to say, hey, keep your eye here for starts or for notice of sales or foreclosure? This is where we're expecting stuff to happen.
Yeah, actually, what I'd turn to for that is our own buyers, what our own buyers are telling us about the market, which they're not telling us directly, but they're telling us through their behavior on our site and indicating where they think the most risk is for a home price correction, home price crash, which then would create that opportunity you're talking about. And when I look at that, and actually Boise didn't make our list because there's just so few foreclosures there right now, so there's not enough volume. So that would probably make the list. But the areas that we're seeing high, where our buyers think the markets are at high risk, and I can go in the details if you want, probably don't have time, but
you can do it. I'm in.
They're basically, they're hedging, they're starting to bid much more conservatively in these areas, hedging against a future home price downturn with their bidding behavior at the auction. And so the markets that are in that camp are a couple coastal California markets, San Diego and San Francisco. And then we see Phoenix, Tucson, and Arizona. So some Arizona markets, Colorado, Pueblo, Colorado, but also Denver. But then those are not as surprising to me because those are kind of in that western area that has seen a ton of price appreciation over the last 24 months. A couple of maybe more surprising high risk areas, according to our buyers, were Minneapolis and Davenport, Iowa, and then Pensacola, Florida, and Lakeland, Florida, getting closer to your neck of the woods.
Yep.
But so that's what I point to. I think then there's a whole, that's like the top tier of risk. There's a whole tier, kind of a middle tier of risk, all through Texas and California and the Southeast. Now you talked about the Northwest, and that does get a lot of headlines. And I think places like Boise, I guess those would be considered the interior Northwest. I think there's risk there, really because it's more short-term risk because of that just run up during the pandemic. So unfortunately, there's a lot of risk to go around at this point in terms of home price decline. And that's where those recent homeowners, especially, are at risk for going underwater. And potentially, if you combine that with higher unemployment rate, does start to create a situation where those homeowners are very motivated to sell. And potentially, if they don't sell, then they would fall into foreclosure.
Makes perfect sense. Listen, I know that we're a minute over our allotted time. I like to be respectful of everybody's time, but every single month, the Building Equity Podcast is doing a state of the foreclosure market for our listeners. We'd love to have you back as many times as you'd be willing to come back just to share, but we want to bring this data and just kind of track what's happening on a month-to-month basis, and we intend to do that for the long haul. Darren, thank you so much. Again, we were sitting down with Darren Blomquist, right?
It's actually Bloomquist, yeah.
You know what? I wanted to say Bloomquist. I got a great friend in the industry whose last name's Bloomquist, and I wanted to say Bloomquist, but okay.
It doesn't look like Bloomquist. It looks like Blomquist. So I guess thanks for even taking, having the consideration to ask, but I answer to anything pretty much.
That's nice. Darren.
And by the way, I'd be happy to come back. I really enjoyed the conversation. I think, you're looking at the data in a really, in the right way. And so in a new, a way that's not creating these sensational claims that we're going to be in this amazing, not amazing, but awful crash. But also realizing that there's a propensity by certain folks who are out there pushing information to make things look maybe rosier than they are sometimes.
Sure. Yeah, without question. Again, we were sitting down with Auction.com's VP of Market Economics, Darren Blomquist. I would say the foreclosure prophet is what I'm deeming you, and I hope we can get you back for more insight. My goal, just so you know, is I always want to get substantive conversation, granular conversation, and just because nobody else is really talking about that. Again, it's either the sensationalistic, headlines, but when you really start diving in, my goal would be the next time I get you on is I want to be able to get some amazing Comcast, utility delinquency numbers and be able to see, is there any correlation? And we kind of take it from there. But Darren, thank you so much for your time.
Thanks, James. It's great to be on.
And there you have it. awesome conversation with Auction.com's Darren Blomquist. Fantastic. I hope we can get him back here actually every single month would be awesome as we continually update these foreclosure numbers and track what I think is a trend that we're about 24 months ahead of what's coming. So please click subscribe to the channel. Please continue to visit IRA Title Pro. And again, we look forward to working with you as you continue buy, sell, or lend using your self-directed IRA.